Welcome back. So I have illustrated to you, I hope convincingly, that when we combine different securities into a portfolio, portfolio risk is not simply the weighted average of the individual variances or volatilities. Well, what you might already be saying, of course, is that the reason is we need to also consider how these assets co-move together, right? This is the key. When we combine different securities into a portfolio, the variance of that portfolio return will be affected by how these securities co-move together, right? And so to the extent that they are less than perfectly correlated, we may expect them to cancel each other and to reduce the risk of the portfolio, right? So in order to quantify the extent to which assets co-move together, we need measures of co-movement. What are those measures? Well, covariance and correlation. You might remember from statistics, right? These are two measures that allow us to evaluate how securities move or do not move together. Okay, so let me start with the covariance measure. All right, so what is covariance? Well, covariance is a measure of the pairwise co-movement between two securities. One of my colleagues that I like very much uses the analogy of butterflies moving together, right? Are they moving in the same direction or in opposite direction or not related at all, right? Another colleague of mine likes to think of two people dancing. Well, hopefully, you know, when two people are dancing, they're dancing together and they're moving in the same direction. I guess that's not really a requirement of dancing, but anyway, I'm digressing here. Anyway, what is covariance? So mathematically, it is the probability-weighted average of the product of the deviations from the mean. So let me illustrate that. So suppose we have two assets, right, and R1 and R2, right, and they have expected return R and expected return R2, and there are different possible outcomes with probability J, right? Let's say there are M outcomes. So what is the covariance between R1 and R2? We denote that sometimes as sigma 1, 2, right? What is that? Well, it's the probability weighted average of the product of the deviations, right? Deviation of the one times the deviation of the other, right? So you can already see that if both of them are positive, right, they are moving in the same direction. If these are, if one is positive or one is negative, they're moving in the opposite direction, right? So now let's use that expression, that definition, to find the covariance between Toyota and Pfizer, right? Again, this is the familiar table now that you've been seeing, right? Let's now find the covariance between the returns of Toyota and Pfizer. Let me see if I have room here. Yes, I do. All right, so what is the covariance between Pfizer and Toyota? And let me denote that as Toyota and Pfizer, right, like that. So what is that going to be? Well, remember, it's the probability-weighted product of the deviations from the mean. So with 10% probability, we're in an expansion. This is the deviation of the Toyota, and that's the deviation of Pfizer, plus the probability of normal times the deviations from the mean for each one of them, plus the probability of a recession, oops, sorry, minus the mean, finally the probability of a depression, and the product of the deviations from the mean. Right. So if you did all that, I know that's a bunch of numbers, you would find the covariance to be minus 17,820. So what does that number tell us? Well, the magnitude doesn't really tell us much. All we can learn from that number is that the covariance is negative, right? Which tells us the stocks of Toyota and Pfizer move in opposite directions. We can observe that from the table, from the distribution of returns as well, right? See that when Toyota does well, Pfizer does okay, but when Toyota tanks, Pfizer does really well, right? That's the nature of the negative covariance. Now, one problem with the covariance measure is, as I mentioned, is that the magnitude doesn't really tell us anything, right? The sign tells us that they covary negatively, but it doesn't really tell us about the strength of that relationship, right? Instead, we use the correlation measure for that purpose. So what is correlation? Well, we typically denote correlation coefficient as using the Greek letter rho. It's simply the scaled covariance, right? It's defined as the covariance between, let's say, 1 and 2, the covariance between two assets, scaled by the product of the standard deviations of each asset. Now, notice that since the denominator, right, will always have a positive sign, the correlation coefficient will, of course, carry the same sign as the covariance. So if the covariance is negative, the correlation coefficient will be negative. If the covariance is positive, the correlation coefficient will be positive. Moreover, notice that the correlation coefficient can only take values between -1 and +1. So if it's perfectly positively correlated, the correlation will be +1. If it's perfectly negatively correlated, the correlation coefficient will be -1. So going back to our example, let's now find the correlation coefficient between Toyota and Pfizer, right? So what is the correlation coefficient between Toyota and Pfizer? Well, it's going to be the covariance between the two stocks divided by the volatility of Toyota and the volatility of Pfizer, right? I'll remind you what these numbers are. The volatility we found to be 4.02%. The volatility of Pfizer we found to be 5.11%. And the covariance between the two we found to be minus 17.820. Right? So now I can find the correlation, which is minus 17.820 divided by 4.02 times 5.11, which gives us 0.868, right? So the correlation coefficient between the Toyota and Pfizer stocks is negative 0.868. Now look what this number is telling us. The stock return on Toyota and Pfizer are fairly strongly negatively correlated. They're not perfectly negative correlated, right? They do not move one-to-one perfectly, but the negative correlation between them is fairly strong.